Welcome back to Turning Hard Times into Good Times. I'm your host, Jay Taylor, and I'm really glad to have with me again Michael Oliver, who is a regular guest on this show, and Michael's a regular guest on this show because I really revere his work. He passes it on to me, and, you get a sense after you work with somebody for a while whether or not you really your confidence grows or it doesn't. And my confidence in watching Michael's work and all he does it has caused me to gain confidence in his work, and I think maybe it's the approach, the structural approach to markets that he looks at, and gaining an early read of the structure of markets, and I've seen how that's worked out very well. So I'm really glad you could join me again, Michael.
That's always great to hear, Jay. And you always ask the astute questions. That's why I like being here.
Well, I ask the questions that are most important to me as an investor, and I presume that they're important to most everybody as investors. And I might say before we go any further, tell our listeners to go to Oliver MSA, that's Mary Sam Albert, OliverMSA.com. That's Michael's website, and you can gain more information there. We are privileged to have Michael because before he used to be exclusively for the big blue chip institutions that were his clients, and now he is making his service available to accredited investors, and I'm very thankful for that. Michael, one of the markets that I think, and I think you'd probably agree, is the most important market probably is the U.S. Treasury market, one of the most important markets. Anyway, it's certainly, I think I've heard it said 4 times larger than the equity markets in the U.S. anyway, and so it's a monster. Now, we've started to see some very interesting developments recently. We've seen some dramatic increases in the Bund, the German Bund. We've seen some dramatic increases in the U.S. Treasury rates. In fact, I believe the Treasury rates were up considerably again today. What are you seeing now? What is your work suggesting? A lot of people are just suggesting that this is just another blip. And indeed, if you go back to this long-term bull market in treasuries, you could see a lot of moves that are as significant as this one, the one we've had over the last couple of weeks or so. So do you think this is just a blip, or could it be that this 30-year bull market in bonds, this magnificent bull market, could be coming to an end?
Yeah, I go with the latter. I don't have conclusive technical evidence using long-term metrics that say, no, the drop so far in price or the rise in yields has broken the back of multi-decade trend. But I don't think the current decline in price, rise in yields, has spent itself. I think we're maybe half, 2/3 of the way through it. And I think by the end of the year, you're going to see higher rates in notes, T-bonds, bunds, and so forth. And now, caution, if any of that contagion moves into the equity markets and you get a moment of fear where suddenly the S&P drops 100 points or something very rapidly, you'll have a flight to quality back into the T-notes, T-bonds, bunds, etc. It'll likely be a counter-trend flight to quality. But that could happen, so be careful if you short those markets. But I think there's more to come between now and the end of the year in rise in rates, and it will be a disturbing amount. And it certainly has nothing to do with something that the central banks want to happen or are in control of. And I think that's the most important event, is not so much the rise in yields as the proof to investors that, my goodness, they don't control events, particularly in the market they're most focused on. The ECB is focused on buying French, Italian, Spanish debt, and go get a yield chart on the internet of those bonds, 10-year bonds in those various countries, and you'll see one heck of a move. Clearly one that indicates the ECB is not in control of anything. So that's the issue, is the mythology of the CBs. Now, if they lose their veneer in the bond markets, which is their market, after all, what does it mean for equities that have been boosted? The Nikkei, the S&P, the DAX. When you lose your religion, chaos comes into place, and the religion is that they're in control of everything, and they're not. And I think that's what's most important about this bond slide recently.
All right, we're talking about confidence. If the confidence is lost in the gods of the central bank, then we could be looking at some real tectonic shifts, I would think, in various markets, right?
That's what I think is going on. The gold market in particular. I think if you look at the S&P and look at gold over the last 6-9 months, even gold for the last couple of years, you can draw a sideways line. Over this past weekend, I had probably more emails from friends, subscribers, and so forth, panicked about how bad gold looked last Friday, closed at 237. And my only response was, yes, there might be a new low, although I think the November, quote, new low that we made last year was sufficient. It was a panic spike low. I didn't see the technical need for another one, and I still don't see it. And normally in my momentum work, I will see some anticipatory action that says, oh, you're vulnerable. I don't see that right now in gold. I see more or less neutral near-term action, despite the look of price last week, and of course we're up this week. So I think the gold sentiment is a little too depressed for the reality. The reality is gold has gone sideways for 2 years. And this is in an environment where the dollar had one heck of a surge beginning last September. And yet if you look at where gold was last September, we're barely changed. Mm-hmm. So I think these are big, like you say, tectonic plates here. And I think they're positioning.
Yeah, well, I know you're the first one that I heard equate that geological terminology to economics when you outlined about four different major markets a year ago or so. But Michael, I look at one of the things that I've noticed, and this is just I haven't really documented it statistically, but one of the things that I've noticed is that for the longest time there would be money coming in and out of bonds. If it come out of the stock market, go into bonds, come out of the bond market, go back into stocks. Mm-hmm. But what I've noticed more recently is that when stocks go down, sometimes the bond markets go down, yields go up. So that is something that seems to be somewhat different to me. I'm wondering if there isn't something going on beneath the surface. Potentially, who knows? If it's beneath the surface, we don't know. Mm-hmm. But there could be a loss of confidence, a slight loss of confidence in the paper system, although if that is happening, we're certainly not seeing a transfer into gold at this point in time.
I think it's an arm wrestling match, and you have to view it that way. In other words, you've got two titans here. You've got the market forces at work. I'll call them the bond vigilantes in the bond market, the gold bulls, and so forth, who are working in one direction, and the CBs, which have been on top of the situation for at least since 2011 or maybe before then, in terms of pricing assets where they want them to be, not where market forces want them to be. And if there's two egregiously priced markets out there, it would be equities, certain equity indexes in particular, again, the DAX in Germany, not the FTSE in London so much, S&P in the U.S. and its equivalents, and the Nikkei. Those have been overly priced by central banks, as have been the yields of their instruments, which they have gobbled up, and now they're the majority buyers in the marketplace. And I think when that comes undone, you've got to watch for the evidence that gold's going to make its shift as well. And it's certainly built a base. If you want to call sideways for 2 years a base, I think that's what it legitimately could be called. I'm looking for the technical signals that say it's emerging out of the base, just like I was looking for the technical signals that the German bonds were going to break down last April, this past April, which they did. The signals from the S&P are now starting. We broke yesterday through some intermediate structures that I think are important. I don't see enough consensus yet in the U.S. equity market that says, okay, the S&P can be trusted on its face. I'm looking for the NASDAQ 100 to break certain comparable levels. But we're nearing those points in the equity market. And therefore, if you're looking at gold, you better be watching it carefully, because I think if you pop back up in the 1200s again, the threat of another spike to the downside, which is a possibility, I think is off the board. Mm-hmm. In which case, then the only issue for gold is what does it take for it to legitimately break out in terms of momentum factors, to reemerge into a bull trend. Now, if you look at a price chart, that would probably take something well up in the 1300s that would excite you if you looked at a price chart. I'm arguing in 1255 this quarter, or about 1233 next quarter, which is only 3 weeks away, are levels that indicate we're coming out of here, upside. So right. I think it's time. Sit, watch, hold your positions, keep your positions light, but be ready to get aggressive.
Yeah, I think you were suggesting probably not more than about 25% at this point in gold and gold shares, I suppose you were suggesting. And then as you start to get above some of those levels, you'd probably be more aggressive, I guess, right?
That's correct, yeah. In other words, take it as take the breakouts as a ladder. Once you go through each hurdle, then you add. You want to buy low, but you don't want to buy while the pressure is still on. You want to buy when there's some release of the pressure and you can see the upside occurring. And that's what I'm attempting to time, or the downside occurring in the case of the equity markets.
Yeah, and eventually in the gold markets too. But I don't like to think. But I can't say that. I can't let what I like to think get in the way. That's a big mistake that we oftentimes make in investors. In investing, now, let me ask you: do you have some key levels that you'd like to pass along in terms of the 10-year Treasury, which I know is what you're watching in the U.S. sovereign debt market?
I think it did damage last week. I had 126 area as that was a price chart level. In fact, momentum broke down into 127, 128. I'm talking the Treasury T-note futures, by the way. The nearby contracts, the June contract. Today it's trading under 126. Even the price charts did damage last week, and price usually is lagged to momentum. To convert it to yields rather than price, right now you've got the T-note yields, 10-year yields up around 2.37, I think 2.4. I think you can easily see 2.8, maybe higher this year. Now that's significant, considering where we've been. And that's damaging in terms of that sense of, again, who's in control here. And the ECB spokesman, I think a week ago, said, well, this is not upsetting. Baloney. He was quite upset. It was palpable when you saw his comments about the Bund crash. So there's some upset there. These guys are not masters of the universe, and it's starting to become unwound. And when that happens, it can become unwound in all asset categories. And I think gold will be a beneficiary, and gold miners will be a better beneficiary.
Yeah, so you're still more bullish on the miners than the bullion as well.
Bullish on the miners, not day to day, but in net on balance. If gold turns into another uptrend, which I expect to happen, the gold miners should beat it.
And silver more than gold, I think, probably.
Silver more than gold. Same story there. I think silver's poised. The numbers on silver, it's gotten above intra-month for the last month or two, but it keeps going back down, not closing the month there. It's just above $17 on a monthly close. Looks quite good to me. We're down around 16 right now. But in 2 days you can be back up there again. So
it's hard to say. So James Turk was saying that he believes that silver is the most undervalued asset on the planet right now, and it could be. It's really gotten hit a lot harder than gold on the downside, which is typically what happens. One more question for you, Michael, before I let you go. Here was: do you have some targets then on the S&P that you're looking at that we should be mindful of?
When we opened the year for trading, I had a range for the predicted range for the year. Because everybody else did it, I said, me too. So I put out a report called Me Too. And I had the S&P chart, simply price, and I put a rectangle where the high of the year would be and the low of the year. And the high of the year was 2130. Now last year we closed at 2059. So I'm projecting we went up another 70 points, okay? The high so far has been 2030 and change on a peak close. So we closed slightly above that. And now, of course, we're 2085. So we're 50 points off that high, 2130. The low for the year, I think, should be in the 1600s and is likely to be there.
Wow. Okay.
Now, I'm not arguing that that's the low of a bear market. I'm arguing that for this year, that is a likely area of support for this year.
All right. Well, those are some things to keep our eyes on. And again, I want to thank you very much for coming on the show and sharing your wisdom with our listeners. Again, I would suggest to people that they go to olivermsa.com. Oliver, M as in Mary, S as in Sam, A as in Albert. Oliver MSA. That stands for Momentum Structural. What's the A? Momentum
Analysis.
Analysis, of course. Well, and looking at things from a structural basis, that makes sense. And you draw some neat lines that show the areas that need to be exceeded or broken down on the downside before you get. And what I've noticed is, one of the outstanding ones was your call on Chinese stocks. I mean, it was just magnificent. But I've noticed others that have worked out very well since then as well. So I want to thank you very much, Michael, for being with us, and look forward to doing it again, hopefully next week again.
And thank you, Jay. Bye-bye.